All right, let's dive right into this explainer and cut through all the noise of today's incredibly chaotic financial landscape. We're here to uncover the actual, steadfast principles you need to protect and grow your wealth. Look, right now, the financial world feels like it's spinning way faster than ever, and frankly, it is so easy to get caught up in the frenzy. But as any seasoned financial advisor will tell you, surviving this environment isn't about moving faster. Actually, scratch that. It's really about seeing clearer. So, here's our roadmap for today. First, we'll map out the new financial minefield. Then, we're avoiding the hype trap. After that, unpacking private credit risks. Then we'll be navigating geopolitical noise. And finally, we'll wrap up with your action plan. Section 1. The new financial minefield. Right now, we're navigating a market where extreme geopolitical shocks and wildly complex assets are all competing for your money. When JP Morgan's CEO, Jamie Dimon, was talking about recent loan defaults, he used this analogy, and man, it is spot on. He said, when you see one cockroach, there's probably more. It brilliantly illustrates the underlying anxiety in the financial sector today. In these highly complex, opaque markets, one bad headline or a sudden bankruptcy is rarely an isolated incident. It almost always uncovers a whole nest of hidden systemic risks just behind the walls. Section 2. Avoiding the hype trap. Let's look at a pretty stark contrast when it comes to these new hazards. True investing relies on fundamentals, right? Owning productive assets that generate compounding cash flow over time. But what we're seeing explode online lately is essentially gambling dressed up as finance. I mean, prediction markets let you place binary bets on news events like elections or when legal files get released. It's an all-or-nothing, zero-sum game that literally has absolutely nothing to do with building long-term wealth. Despite the massive marketing push from platforms like Kalshi and Polymarket claiming you can trade off your unique insights, well, the blockchain data reveals an incredibly harsh reality. Get this, 84% of retail users actually lose money. You're facing an asymmetric risk profile, where your upside is often capped at a tiny percentage, but your downside, that's losing 100% of your bet. It is basically a very expensive casino disguised as an investment exchange. And we see this exact same illusion of an edge in those viral TikTok prop trading schemes. Influencers will sell you on the dream of trading with a firm's capital and splitting the massive profits. But here is the dirty little secret. The business model isn't actually about making you a successful trader. No way. It's about collecting the upfront evaluation fees when you inevitably fail their incredibly strict, near impossible parameters. You aren't the trader here. You are the product. Section 3. Unpacking private credit risks. Chasing yield without understanding the vehicle is inherently dangerous. When we break down the mechanics of private credit into simple steps, you can really see how it operates entirely outside traditional banking regulations. Firms raise capital, they lend directly to private businesses, and crucially, they reserve the right to gate or lock up your money when panic hits. Think of it like a crowded parking garage that suddenly locks its exit gates the exact moment everyone tries to leave at once. And this isn't some small niche corner of the market anymore. To put this in perspective, the U.S. private credit market has exploded to an estimated $2 trillion. $2 trillion! It has aggressively filled the lending gap left by traditional banks after the stringent regulations of the 2008 financial crisis. So let's walk through how this risk actually materializes. When a few highly leveraged companies, like First Brands for example, default, these private funds are forced to aggressively mark down their assets. And because these loans are completely illiquid, the funds have to quickly gate or freeze retail investor withdrawals to prevent a catastrophic fire sale of their assets. You know, you might have amazing returns on paper, but if you can't access your cash when you actually need it, those returns are completely meaningless. We're even seeing this illiquid model being pitched at the national level. The new $25 billion Canada Strong Fund is a proposed sovereign wealth fund that plans to invite retail investors to co-invest in private infrastructure projects. It really highlights why everyday investors need to deeply understand liquidity risk. Infrastructure takes years, sometimes decades, to generate a return. Once your money goes in, it might be heavily restricted from coming back out. Section 4. Navigating geopolitical noise. This brings us to a massive source of financial anxiety that tests literally every investor's discipline. Take international trade, for instance. The recent Canada-China trade deal immediately slashed devastating tariffs on Canadian canola oil, dropping them from a staggering 84% down to just 15%, while also lifting heavy levies on electric vehicles. This perfectly illustrates just how quickly protectionist policies can reverse course. If you were trying to time the market based on yesterday's tariff headlines, you'd be completely blindsided by today's diplomatic agreements. And we see this across the board, whether it's the outbreak of conflict in Iran threatening the Strait of Hormuz, which, sent oil prices spiking 30%, or the deeply complex fiscal debates driving the Alberta separatist movement in Canada. Geopolitical events create very real economic volatility. They disrupt supply chains, inflate short-term prices, and cause political instability. But trying to consistently predict these outcomes, it's practically impossible. While a sudden war might prompt TikTok gurus to confidently tell you to dump all your cash into defense contractors or gold, true investors know that trading on short-term headlines is a fool's errand. By the time you read the news, algorithmic trading bots have already priced it in. Even major defense stocks have seen flat or downward volatility during recent conflicts. The real secret is to step back and focus on how fundamentally strong companies perform across entire long-term economic cycles. Section 5. Your Action Plan. Okay, let's bring all of this together. To truly act like the wealthy, you absolutely must avoid the high-fee hype traps of social media trading. You've got to understand the hidden illiquidity inside trendy alternative assets. If you can't sell it, demand a higher premium for it. And most importantly, you have to steadfastly ignore the panic of the 24-hour news cycle. A well-constructed, globally diversified portfolio is specifically designed to absorb these shocks, so you don't have to hit the panic button every single time the headlines turn red. So, I'll leave you with this question to discuss with your fiduciary. Are you investing in a boring, beautiful, compounding future? Or are you just gambling in a very expensive, very noisy casino? Take control of your plan, tune out the static, and as always, stay focused on the long game. Be sure to reach out to a trusted professional to align these insights with your personal financial goals.